Welcome to the Financial Fast Lane. Today I have a very special guest, Mr. Ed Slott CPA. He is known as America's IRA expert. Him and his team, he's built a very impressive organization to train people like me, financial advisors, on the finer points of tax and the importance it plays in retirement planning. So Ed has created a new video. It's on demand. It really goes into a lot of stuff, taking into account some of the things we're going to talk about in this video today. But we're going to have a link for that, and we're going to be showing you a 2-minute trailer to give you kind of a preview here near the end. But Ed, thank you for coming, and thank you for being here. I've got some questions for you.
All right. Well, first, it's great to be here with you, and I always enjoy it because you've done the work. You've invested in your education to learn these things. You made light of it up front. Well, we talk about retirement tax planning, but that's everything. Remember, when you have most of your money, like most people do in an IRA or 401k, that money has not yet been taxed. It's not yours till it passes through the government. And that's the whole key, to minimize that tax bill. And that can be done in a whole host of ways. But for most financial advisors that don't have the training, I'm not talking about investments. The investments really, it's great to make money, but when it comes to your IRA, it's what you keep that counts after taxes. It's sort of like a football game, the second half of the game. That's where everything happens. I don't know if you follow the football games, Lay, but you notice how almost everyone is won in the last 5 or 6 seconds or something, a field goal or some event. And then like everything else in the past didn't matter. Those last 5 seconds. That's kind of how it is with tax planning, except in those last few seconds or the second half, really, you're playing against a tougher opponent, the IRS. And they're armed with their own men and women, who knows, own rules. And that's where you need an advisor that's educated on the tax rules in the second half of the game. It's easy to play. I'm not going to say it's easy, but the first half of the game to me is like a football game. The first half of the game, you work, you build, you save and invest. And that's it. You think you're done. Many people leave after the first half in retirement psychologically and say, I've got all the money I'll ever need for retirement. I'm done. We're done. And they walk in and they think they're finished because all along in the first half, they had no opponent. All that money was growing absolutely tax deferred, not tax free yet. So the first half, they had no opponent and they think they're done. Meanwhile, in the third and fourth quarter, IRS comes out, they're playing nobody, so they win because as far as most advisors, the IRS doesn't have an opponent in the second half unless you're in there with an educated advisor. So that's what we do. Like I said, you made it sound like it's so easy, but you've been training this stuff for years. You go to our workshops, you train twice a year, you get updates all throughout the year. In fact, this is the book. You haven't seen it yet. You're going to get when you come to Austin, loaded with all. I mean, we do these every 6 months for you guys or in between if something breaks. This is another 300 pages or so of new stuff since we met in May. It's unbelievable. Has all the new ABA provisions. So this is the kind of investment that Lane makes for people watching to be able to help you keep more of your hard-earned money. And it's not most advisors. I think people think their advisors have this covered, but I know from experience they don't. And that's one of the reasons we put out this video.
Yeah. And I'm looking forward to that. We're going to be with you for 3 days in Austin here,
Yeah.
just in a few weeks. Now, something I've heard you say to Ed is that an IRA is a joint account with Uncle Sam.
Yeah.
Well, what do you mean by that?
Put it another way, your IRA is an IOU to the IRS. Remember, they're playing in the second half. They have no opponents unless you have the planning. Well, like I said, the IRA hasn't been taxed yet. There's a big difference between tax deferred and tax free. And that big difference comes down to one little 3-letter word. That word is YET, yet. Tax deferred means you won't pay taxes on that money yet, but you will at some future time, at a future date, maybe at a higher balance, maybe at a higher rate. possibly leaving you with less when you'll need it the most. So up until until it's eventually taxed, and it will be taxed, it is a joint account of sorts. When I mention this at consumer programs, I always say the same thing, Lena. Your IRA is a joint account with IRS. And people look at, and some people ask, what do you mean, a joint account like husband and wife, 50-50? I said, no, 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 no. Uncle Sam is a special kind of joint owner.
Sure.
He gets to pick what his share will be based on when you need the money the most. He may say, you know what? We have large deficits, debts. Maybe I need 60%. Maybe I need 70%. We've had rates during the baby boomer birth years, 1946 to 1964, of over 90%. I don't think we'll ever go back to that, but rates could go up. So in effect, it's a joint account until you unwind that. Every time your IRA goes up, look, the market's been doing great and people see their balances going up, but the government share is also growing. Uncle Sam is a partner on your retirement savings. When it goes up, so does his share.
Right. Now, I know a lot of retirees, they worry about volatility in the markets.
Yeah.
In retirement. But I've heard you talk about how the tax implications should be something maybe even a bigger thing to worry about. Tell us about that.
Yeah. Well, see, the thing with the market is the market we know goes up and down over time. I mean, it goes up over time, but up and down over time. It's all in timing. They say the market returns over time unless you run out of time. You retire at the wrong time and when it's a down market. But the money, let's say you lose money in the market because the market goes down. You don't really lose until you sell, but let's say the market goes down. All right, that's temporary. But when you lose, because the market will recover eventually over time. But when you lose money to taxes, that's never coming back. That's a permanent loss. So you have to get it right the first time. And the problem, the challenge, which you know because you study this stuff with us for years, the challenge is the tax laws, for some crazy reason, we don't know why, but the tax rules surrounding retirement savings are among the most complicated and the most unforgiving, meaning many things are unchangeable, unforgivable. Irrevocable. You can't change them. One mistake can wipe out a good chunk of your retirement savings. So they're complicated and unforgiving at the same time. So that really presents a challenge to get the answers right the first time.
Right. So let's talk about some potential mistakes for people in their 50s and then in their 60s and then in their 70s and how that's different in each stage.
Well, in your 50s, hopefully you don't need to tap into your retirement savings. That, I think, is a mistake. The whole point of retirement is for retirement. But yet the government, they do both things. They deter it and they encourage it at the same time. They deter you by having a 10% penalty. That was the original point of having a 10% early withdrawal penalty. What that means is if you take your money out of an IRA before 59 and a half, you'll pay the tax, of course, but also a 10% penalty. To me, that's a deal breaker. That's a waste of money. But they also, so that was a deterrent to make people hold it for its intended purpose, for retirement. But then over the years, they started adding exceptions, ways to get at it that are exempt from the 10% penalty. And after Secure 2.0, we have now 20 exceptions. So in some ways, I wouldn't say they're encouraging you, but they realize life happens. And sometimes that's the person's largest asset, and they need to access that money, whether it's for medical reasons or higher education or all kinds of things that could happen to you. So they have disability, death. I mean, there's a whole list, 20 different exemptions from the 10% penalty. But people miss the point of this thing. Yes, if you qualify for these exceptions, and even this whole area is complicated. That's why we did the video in the 50s, because you want to hold on to it if you can until you're 59 and a half, where it's penalty free. And the problem is that it got so complicated because not all exceptions apply to all accounts. There are exceptions from the 10% penalty that only apply if you take it from an IRA. There's another list of exceptions that only apply if you take it from a plan. There's another list of exceptions that apply whether you take it from the IRA or a plan. So it can get very complicated. And because they promote these exceptions, I don't know if I should say promote, they've added them to the tax law to make it easier, which I don't know if is good, to get to your money. But they leave people with the impression that, oh, I need it for a first-time home buyer, or I need it because they're disabled or long-term care, whatever. There's a bunch of exceptions, like I said. So they have the impression that, oh, it's not taxable and there's no tax on it. I could just take my money out. No, there is a tax. You just don't have to pay the 10% penalty. You still have to pay the tax. So the trap, some people, especially in their 50s, they say, well, I'm close to retirement. I'd like to use some of the money now. So they take the money out. And it should only be a last resort. Use any other money first before tapping into a retirement account before retirement to avoid this 10% penalty. So they tap into the account, and if they need the money, if they're desperate and financial straits, they need the money. Let's say they need $5,000, take it out of the IRA. And let's say they hit one of the exceptions. So they don't have to pay the 10% penalty, but they still have to pay the tax based on their own rate. So if you take the $5,000 and you need the money, it's likely you're going to spend it all, not thinking hold some back for the tax. Then next year you get the tax bill. Maybe it's $1,000 of tax, no penalty if you qualified for the exception. If you didn't qualify, it's another 10%. Now you need to come up with another $1,000. Well, you don't have it. You spent all the money. So this gets into a cycle of taxation. I had this years and years ago with a client where they needed money. They just got married. They needed money. And it was a later marriage. They were also in their, I think, late 40s, early 50s. And so, well, we need it. And they thought they forgot about it. Even though I told them, they took the money out and spent it. And this was a lot of money, I think over $50,000. And next year, they got a tax bill on the $50,000 and they didn't have the money because they spent it all fixing up a house and all these kind of things. So then they needed more money to pay the tax, which they didn't have. So they took more money out of I think he took it out of his 401k, and no exception applied because they needed the money to pay the tax. So they took taxable money from their 401k. Now they have a tax and a penalty. And what are they using the money for? To pay a tax and a penalty. So, you go down the drain with that thing. So I would say there are things you can do, but try to hold off on your retirement savings until at least 59 and a half.
Yeah. So what opportunities open up in the 60s?
Oh, in your 60s, I call that the sweet spot. As you know, I've always said that in our programs for planning, because before 59 and a half, we talked about the 10% penalty, so you constrain there. At 73, RMDs, required minimum distributions, kick in. So you're constrained there. You're forced to take money whether you need it or not. But let's say from 59 and a half to 73, I call that the sweet spot. Let's call it the 60s. You can't get a penalty. It's a free-for-all. I call it the oasis, the sweet spot for planning. You can't get a penalty, even if somebody came to me, but Ed, I want to pay a penalty. Nope, you can't pay a penalty, no matter what you do. But I want to. Nope, can't. So that's where, if you're in your 60s looking ahead to retirement, maybe now it's time to start drawing some of this money down while rates are low. Remember, we have a new tax law, the ABBA, One Big Beautiful Bill Act, and the tax cuts were extended permanently. Well, let's stop there a minute. If I look in the dictionary, I have one behind me, but I don't have to. The word permanent means unchangeable and permanent. But in the tax code, permanent only means till a future Congress change it. As CPAs, we have this saying, tax laws are written in pencil. But they will be here for at least a few years, I believe. So take advantage of low rates. The key in life to saving, it's so simple, but most people miss it, to saving the most in taxes. And that's what this is all about. Tax savings you get to keep. That's where you make your money. In the stock market, it's all speculative. With tax planning, you can actually make money. You don't have to worry if you do the right planning. And the key, the foundational principle of always saving the most money in taxes over your life is my always rule. Always pay taxes at the lowest rates, even if they're not required. So let me give you an example. I just said RMDs, required minimum distributions. They're not required till 73. So somebody in their 60s might say, so why should I take it out before I need to? Why would I pay tax before I have to? To get it out at these rock bottom rates, you have a 22%, 24% bracket. And I'm not talking about just taking it out and blowing it and spending it. No, this is opportunity for a Roth conversion. If you can get that money out at low rates, even though it's not required, get it out now, move it into a Roth IRA, and you do a little each year using up these low brackets. Another great rule of tax planning is to always optimize or maximize low brackets. Anytime you don't use up a low bracket, that bracket is wasted. It's gone forever. You never get it back. I've had accountants come up to me at programs proudly and they would say, oh, Ed, I had a client and I kept him in the 12% bracket. I say, oh, I'm sorry to hear that. You could have taken so much more out at the 22, 24% bracket, put it in a Roth. So now the compounding, the growing, remember earlier we said the IRA is an IOU to the IRS, a growing, building, compounding debt, because in essence, it's some sort of joint account with the IRS. So the compounding is working against you. In the Roth, the compounding is working for you because now, once it's growing in a tax-free account, income tax-free account like a Roth, now the compounding is working for you. You keep 100% of those gains. So I would look in my 60s to start bringing those balances down, do a series of smaller conversions, annual conversions over time, to over time bring down that IRA balance. Most people have too much in their IRAs, especially with the recent market run-up. And the beauty of the 60s is because the distributions are not required, you can control your tax rates. You can control the rates you pay. You determine how much you want to take out. And you do this with planning like you do with your clients. You come down towards the end of the year. You have a good idea where the income may come in. And you get your tax chart, which I know you have from our meetings. And, oh, by the way, today they just released, IRS just got this 2 hours ago, the 2026 rates just came out today. And those will be adjusted, are already adjusted for inflation. Even more money can come out next year under these low rates because they increase. The inflation increases, these cost of living adjustments weren't as high as we thought because it has been low inflation, at least from the government point of view. So you have more opportunities next year, but you do this over time. The key, not only paying taxes at the low rates, but having control over which rates you want to pay, how far you want to get, because nothing's required. Once you hit age 73, you're forced to take money. It's not under your control anymore. And one of the mistakes that happen for people that wait, they blow the opportunities in the 60s, they wait till 73 because their accountant unfortunately says, oh, you don't have to touch anything till 73. But by 73, that account could double. And so could Uncle Sam's share. So at 73, we have this situation I've seen happening where you're forced to take it out. You probably have clients in this situation where they're already in RMD age, 73, 75, 80, and they don't need the money, do they? But they have to take it out, right?
Right.
Yeah. So you know what happens? It's something I call unspent RMDs. That's a problem. Why? Because it was growing tax deferred. Now you're forced to take it out and put it where? You can't put it back in a deferred account. You can't take an RMD and convert it to a Roth. Now you have to put it back in some kind of taxable account. And now you've turned it back into a taxable account on money you didn't need anyway. So now the interest, dividends, capital gains, whatever kind of earnings it throws off, become taxable again.
Right.
All of this can be avoided in your 60s with creative planning.
Yeah. Well, thank you for that. So what are some of the mistakes, or why are there rollovers prone to mistakes?
Oh, okay, that's a different area. That's all about rollovers. That's a different area when you move money. In
Right.
essence, a Roth conversion is a rollover from an IRA to a Roth. But many people do these things the wrong way, or they don't know the difference. And this is, again, where even if you're a do-it-yourself or you think it is too much involved, you're talking about your life savings. At a minimum, get a second opinion from an educated advisor. This is why we created this group. And I didn't name the group, but you know what I'm talking about, and they do. Ed Slott's Elite IRA Advisor Group. This is what Lane and many of our members will get when we meet in November. A manual based on all the updates, has all the ABA updates, whatever came out in the last 6 months. And if there's something really big, as you know, Lane, we give you what we call an elite alert, so you know the day it comes out. Now, not everybody is up on these things.
Right.
And rollover and the decisions you make, like I said before, are irrevocable, etched in stone. Sometimes you can't undo it. So there's a few ways to move money from a 401k to an IRA or IRA to Roth, and a direct rollover, or what we call a trustee to trustee transfer, where you don't touch the money in between. Now, that's where you may need the help of an advisor like you do, Lane, with your clients, to make sure it moves, say, directly from the 401k to the IRA without anybody touching the money in between. And that's critical if you're moving, let's say you're retiring and you're moving money from your IRA because you decided that was the best option. There's other options, but let's say you decided the best option was to roll it over to your own IRA. If you take a check, if your name is Mary Smith, and you take a check made out to you personally, to Mary Smith from your 401k, your company, and you say, let's say your balance in the 401k was 500,000. You're not going to get 500,000. You're only going to get 400,000. You say, well, where's the other 100,000? By law, it had to be withheld because you took a check. So now you only have 400,000 to roll over. And if you don't have another 100,000 sitting around to complete the 500,000 rollover to your IRA, you're going to be taxed on the money withheld for taxes.
Right.
You do instead a direct transfer. There is no 20% mandatory withholding requirement. That rule only applies 401k to IRA. So with 401ks to IRAs, always do direct transfers and avoid the 20% withholding rule. There's two other rules, too, that can catch you by surprise. There's I forget, where are you located, Lane?
We're in Tempe, Arizona.
Oh, Arizona. Okay. Let's see. I'm trying to see. Is there a college? Well, I was getting to college football. You see where I'm going with this. But there's an old saying in college football, and everybody that follows college football says their coach is the one who said it. When you throw the ball, three things happen, and two of them are bad. Most people say it was Woody Hayes from Ohio State. Some people say it was General Robert Nealon from University of Tennessee. Anybody who goes to college says their coach said it. When you throw the ball, two things happen, and three things happen, and two of them are bad. When you move money from an IRA indirectly, where you take a check to another IRA or a 401k, three things happen, and they're all bad. I gave you one of them, the 20% withholding trap. If you move money IRA to IRA, there's a once per year rollover limit. If you didn't know that and did an indirect rollover where you take a check made out to yourself personally and you do that a second time, that whole check is taxable and there's no fix in the tax code for it. Also, if you do an indirect rollover where you get a check personally rather than a direct transfer, you only have 60 days to deposit that money. If you miss the 60 days, the whole thing can be taxable. So these mistakes involve your life savings. When it comes, say, from the 401k, that could represent 30 years of work. And you make one wrong move, all of a sudden it's all taxable. So always move money directly, a direct transfer, direct rollover from a 401k by direct. You don't touch the money in between. You say, I'm out of it, move it directly from the IRA to another IRA, the plan to an IRA, the 401k to the IRA, and none of these three rules apply. You can't have a problem.
Right. Yeah. So how important are checking and verifying your beneficiaries? And what are maybe some of the some horror stories, I guess.
That's where all the horror stories are. That's another area that sounds so simple. And it's so simple, we beat you over the head with this in every meeting. Check beneficiary forms. In every meeting, we have some case where somebody didn't name the right beneficiary or thought somebody else did. And most people don't pay attention. The beneficiary form is the one document that will determine how much you keep and how much goes to the government. And it could determine the time when it's taxed, how it's taxed, because there's different designations of beneficiaries under the tax code. Another thing that's complicated depending on how you inherited it. The beneficiary form also overrides your will. People think, oh, that's covered in my will. No, it isn't. I've talked to attorneys. Maybe they have set up trusts for these IRAs. And they say, oh, we don't need a beneficiary form. It's in the trust. Well, how's it going to get to the trust? By osmosis? You still have to name the beneficiary on the IRA beneficiary form. So if you don't have a beneficiary named, you don't know where it's going to go. Now, you might say, well, the courts will decide. Yes, in general, that's what happens. There's a probate that's done if you don't name a beneficiary. And what's going to happen, it's going to go who the state picks to be your beneficiary. Most time it'll be a spouse, a children. They have laws of intestacy laws, but then there's probate fees. And somebody can get disinherited. If you're disinherited because you weren't named or the intended beneficiary wasn't named on the IRA beneficiary form, not in the will, if you're disinherited, that's like 100% tax. We've seen cases. I had a case years and years ago. I always say years and years ago because I've been doing it at this desk for all these years. Very large IRA. I don't remember what it was, like 10 million, which was large even at that time. Large even now, I'd say that's large. But
Sure.
But it was a complicated estate. And there was a second marriage and all these things. So they decided there was a business involved and IRAs. So they decided, the kids that are not involved, and the kids were grown-ups, adults already, the ones not involved in the business, give them the IRAs because it was similar in value, just to make it easy, say $5 million worth of IRAs and the business is worth $5 million. All right. So they said, we'll leave the IRAs to the kids and the business interests about the same. Leave to these kids as they're working in the business and they'll be the successors. What they didn't do is name these kids as beneficiary on the IRA. They just said everything else goes to the other side. But they didn't name the kids. So when the guy died, everything, the 100% went to the kids and the business. These guys got disinherited because they weren't named on the beneficiary. They thought it was covered in the will. So that's one example. There are tons of other examples where I had one in my own family. I don't know why this happened a few years ago. My uncle didn't consult with me before he died. He had 3 kids. And 2 kids lived far away, but one kid was taking care of them. When I say kids, again, adult children, my age, my cousins actually. And so he said, look, he did this on his own without consulting me. We didn't know till after he died. He named his one child who was taking care of him as the beneficiary on the IRA. He wanted the IRA to be split equally between the 3 children. But because this one kid was doing all the paperwork and not for malicious reasons and nefarious reasons, he just thought that's the way to do it. He'll take care of everybody else. So when he died, that kid was named 100% beneficiary. But the kid wanted to do the right thing. He knew what his father's wishes were. He says, I want to split this between the 3 of us. The only way he could do it is distribute the whole thing, pay tax, and divvy it up that way. Pay the tax, and so much was lost in taxes. All my uncle had to do, really, was just name the 3 kids 1/3 each on the beneficiary form. But he thought because it was in the will that he wants this kid to take care of the others, that would take care of it. So the beneficiary form, it's very important not only to name an individual as a beneficiary on your beneficiary form for every IRA, but also name a second or contingent beneficiary in case that first one dies and you have a path to who gets it after. To keep it out of the courts, out of probate, and out of unknown territory, unintended consequences where somebody could be disinherited.
Right. Now, a spouse as a beneficiary has So maybe just briefly explain the difference between a spousal beneficiary versus a non-spouse.
Well, spouse has special rights only in company plans like 401ks. If you want to disinherit your spouse from an IRA, you can, except in certain community property states. Those are different rules. But if you have what we call an ERISA plan, it's a tax law that protects retirement accounts, came out in the early 70s. ERISA, Employee Retirement Income Security Act of 1974. Actually, a little history, it was one of the first major tax acts signed into law by the new president, Gerald Ford, on Labor Day, 1974, right after Nixon resigned in August of that year. And it protected these I was going to say pensions, but we don't have, most people don't have pensions anymore. Now they're truly retirement accounts, 401ks. And one of the provisions is if you have a spouse, the spouse is automatically your beneficiary unless you name someone else and she waives her rights to it. But if you don't do that, somebody can get disinherited. So there was a major court case, a Supreme Court case, where they decided unanimously. When's the last time you saw a Supreme Court ruled unanimously? This was the famous Kennedy case, which we've studied in our training programs, where there was a second spouse. The first spouse died, and this one, there was another case. In this case, it was the spouse, but he wanted to leave it to his daughter. And the spouse, the wife said, that's fine, leave it to the daughter. That's okay, I have my other money. And he changed the beneficiary to his daughter. Well, after he died, the wife had second thoughts. Says, I decided I want the money. It was $402,000. I want the money. Well, the daughter went to court. Now, this can't be good. You have the daughter and the mother suing each other in court. Can't be good for family relations. And it took 7 years. It went all the way up to the Supreme Court of the United States, which ruled the mother gets the money, even though she wasn't on the beneficiary form. So here's a situation where he named the wife as even though the daughter was named the beneficiary, where he named the daughter as the beneficiary. So she had every right. She went off to the Supreme Court all the way up, said, he named me. I'm the beneficiary. I thought the beneficiary trumps all. No, because the wife didn't waive her rights under ERISA. So she got the money. So the daughter, the intended beneficiary that the husband and wife agreed on, did not get the money because they didn't follow the rules in the plan. If he wanted the daughter to get it, he changed the beneficiary form, but the wife has to sign a waiver and consent to that. And that didn't happen there. So there's another one of these horror stories. We have tons of them. You could do a whole program, a whole day of programs on beneficiary form mistakes. But the biggest mistake is thinking somebody took care of this. You better check. I know you take care of it, Lane, because, like I said, we beat you up over the head with the check beneficiary forms. Check beneficiary forms. I always say check them once a year, or whenever there's what I call a life event. You have a birth, a death, a marriage, a divorce, a change in the tax law like we have now. You had a new grandchild. Update these beneficiary forms and make sure people know where they are so they can present them. If they don't know where they are, it's the same thing as not having a form. And don't rely on the bank, the broker, or the fund company to say they have it on file. We've seen bank mergers, and all of a sudden they can't find anything. If they can't find it, it goes back to what the state says. Now you go through probate, and you don't know who's going to get it. Beneficiary form is critical. Know where they are. Make sure they're all up to date. Make sure they name a primary or several, and a secondary, remainder, or a successor beneficiary contingent.
Yeah. Well, thank you. I know we could probably talk for hours.
Oh, yeah. I got, we could do this. That's what we're proving is how detailed it is. These are deep waters. Most people don't realize it. And the big mistake in all of these areas, we don't have to go to every area, but the big mistake people make is thinking somebody took care of it, thinking their advisor took care of it. The advisor may make you money in the market, but he's generally not doing this kind of tax planning. In fact, as you know, Lane, a lot of advisors put on their cards, we don't do tax planning. It's like kryptonite. They can't touch it. Right. They don't even want to go near it. But that's the key to all of this. And that's something you specialize in. You chose to do this years ago by joining our advanced training on tax planning for retirement savings. That's where all the tax planning is done, and it's missed. I would say 99% of advisors probably don't do this tax planning, including CPAs. You would think CPAs do this. Most CPAs are the other way. They're more short-sighted. They look at saving you taxes today rather than saving you a lifetime of taxes. And that's where you have specialized knowledge. So I want to congratulate you for doing the right job investing in your tax planning education. That's where you can make clients a ton of money.
Well, thank you very much, Ed. And I want to thank you again for Ed wrote the foreword in my new book. And so that's something I really appreciate. And so now you've put some work into making a special 40-minute video.
Right.
And it's going to be on demand. And so we're actually going to show a 2-minute trailer here at the end. And then I'll also have a link below in this video, so you can just click and you'll be able to watch that video that Ed's put together.
And I'll tell you something about it. I won't say tax videos are fun, but because they're not. But this one is engaging. We talk to you just like we're talking, things you can understand, very understandable items. We go through similar what we did here, what to do in your 50s, 60s, 70s, where the traps are, where the benefits are, where the choices are. And we lead you to a free video. It's about 40 minutes. And you get to hear from not only me, from our team of experts who you trained with, Lane, Sarah, Andy, and Ian. And you get to meet the people that Lane is training with year round. And I think you'll enjoy this video. And I'll bet when you watch it, you'll say, oh, I wonder why I'm not doing that. Oh, maybe it's going to give you ideas to help you keep more of your retirement savings. That's what it's for. Not so much to save taxes now. In fact, it's the other way. Sometimes paying tax at low rates gives you more tax-free and more money later in retirement. And for your beneficiaries. So you're going to get the long-term big picture. Wherever you are in the spectrum here, we're in their 50s, 60s, or 70s. So that's how we broke down the free video. I think you'll get a kick out of it, and you'll understand the kind of intense training that Lane goes through all year round.
Yeah. Well, Ed, thank you. Really appreciate it. We'll look forward to seeing you soon in Austin, Texas. So
yeah. If not sooner, if something else breaks, you never know.
Right. Okay. Thanks again.
Lane.
We'll end for now. Have a good day.
You too.
Okay, we'll see you.
Think your IRA is all yours? Think again. It's actually a joint account with Uncle Sam. And if you don't take control, he will.
The biggest threat to your retirement isn't the stock market, it's taxes. And the worst part, unlike market losses, money lost to taxes never comes back.
Most people focus on saving for retirement, but almost no one teaches you how to take that money out the right way.
And one wrong move, whether it's a rollover, an inheritance mistake, or an RMD error, can cost you thousands in excessive unnecessary taxes.
Your IRA is an IOU to the IRS. A growing, compounding tax bill.
But the good news, you can take control legally, ethically, and strategically. The question is, do you want your plan or the government's plan?
That's why we created this free special to show you exactly how to keep more of your hard-earned savings and avoid the biggest retirement tax mistakes.
Whether you're rolling over a 401k, inheriting an IRA, or planning for RMDs,
what you do next could save you thousands. We'll break it all down in simple, easy to understand steps. Ready to avoid costly mistakes? Watch now.
We have to apply ourselves and get the best updated knowledge and strategies available from the best sources, and that's what's right here.
Every single time, and always learn something new from some of these outstanding advisors that are really the top of the top here in America. I mean, you always want to be around people that you can aspire to be like, whether it's professionally or personally.
Wow. Just wow. It's been incredible. It's a great learning, educational experience. Definitely worth it.